Okay, so this video is going to be looking at the 2013 costing question, and this year what came up was stock valuation, so Fifo stock valuation, product costing, and under and over absorption. So taking a look at the question first, part A, stock valuation. So Blue Limited is a retail store that buys and sells one product. The following information relates to the purchases and sales of the firm for the year 2012. So you've got the 3 periods there, you've got purchases on credit, and you've got credit sales and cash sales. On the 1st of 1st, 2012, there was an opening stock of 4,500 units at €5 each. Part 1, you are required to calculate the value of closing stock using first in, first out Fifo method. Part 2, prepare a trading account for the year ending 31st of the 12th, 2012. Part B then, we've got a product costing question. So it says the following is the budgeted yearly overhead details of Grace Limited, manufacturers of computer equipment, which has 3 production departments. Production departments, we've got manufacturing, assembly and finishing, and you can see there that they've got budgeted overheads, budgeted labour hours, wage rate per hour. Budgeted general and admin costs for the year, 1,170,000. Details of job number 666. Direct material, 30 kgs at €10.20 per kg. Direct labour hours, manufacturing 20 hours, assembly 6 hours, finishing 4 hours. All orders are priced using a profit margin of 25%. So what is required? So required, calculate the overhead absorption rates for each department, and 2, calculate the selling price of job number 666. So that's part B. Part C then is under and over absorption. So the information set out below refers to the budgeted and actual costs of Hake Manufacturing Limited. So you've got budgeted figures there for department A, B and C. You've got direct labour hours, machine hours, total overhead, and then you've got the actual. So you've got the actual direct labour hours, the actual machine hours, the actual total overhead. So what is required? So 1, calculate departmental overhead absorption rates for departments A, B and C, and 2, show the under over absorption by department and in total for the period, and explain what these figures mean. Okay, so we're going to get started then in part A, which is all about our Fifo stock valuation. So this crowd buys and sells just one product. There's 3 4-month periods of the year that they break their information down into. You can see that they've got purchases on credit, they've got credit sales, they've got cash sales, and you can see that they buy and sell different amounts and at different euro amounts as well. Okay, so it says then on the 1st of 1st, 2012, there was an opening stock of 4,500 units at €5 each. So what is required? So part 1, calculate the value of closing stock using first in, first out Fifo method. And then part 2, prepare a trading account for the year ending 31st of 12th, 2012. So the value of closing stock using Fifo. Okay, so first in, first out, that basically just means that the stock that they buy the first is what they're going to sell first. Okay, so the stock that they buy first is what they are going to sell first. So they sell this one first, then they sell these units, then they sell these units. So they sell it in this order. So if we have any closing stock left, it will be, going up like this. So we'll have the 1,700 will be the last stock that we have, and then we might have some of this stock and so on. So right, so first in, first out, they sell the stock that they buy first. Okay, so looking at this then, so before we can calculate the value of closing stock, we would have to calculate how many units of closing stock that there are at the end of the year. Okay, so how do we do that? Well, what we'll do is we'll imagine start of the year in the warehouse, they have 4,500 units. Okay, so that's in the warehouse at the start of the year. Then during the year, they purchase 4,000 and 2,500 and 1,800. Okay, so that is 8,200 altogether. And then what they do, they have made all of these sales then. So they have sold loads. So 1,000, 1,200, 1,400, 1,500, 1,300, 1,200 units. So we add all of them up. That totals up to 7,600 units. And that gives us a closing stock then of 5,100 units. So that's the units that they have at the end of the year, okay? But what we're asked to do, we're asked to calculate the value of the closing stock. So we need to put a euro value on this. Now, we're doing this based on the first in, first out method. So whatever we have bought first, we have sold these first. So the start of the year, we've sold them first, and then we go down and we sell that way, you know. So they definitely have that 1,700 left, okay? And they bought them at €8, so that's 13,600. That leaves you with 3,400. So they definitely have all of these 2,500 at €6 each left as well. That's 15,000. And then that leaves 900. So 900 of these 4,000 here are still left. They were at €5 each, so that is 4,500. So when we tot that all up, the value of our closing stock is €33,100. So that is the answer to part one. So €33,100 is the value of our closing stock. And we will be using that now when we do our trading account for the end of the year, so in part two. So trading account, what does it look like? Sales less cost of sales, opening stock plus purchases less closing stock. Okay, so for me to get my sales, it's just going to be a little bit tedious on the calculator. And what you're going to do, 1,000 by €9 plus 1,200 by €11 plus 1,400 by €11 plus 1,500 by €12 plus 1,300 by €13 plus 1,200 by €14. So that all tots up then to €89,300 in your sales. Then we take away the cost of sales. So opening stock then, 4,500 units by €5 each. That is opening stock there, €22,500. Then we tot up all of our purchases. So 4,000 by 5 plus 2,500 by 6 plus 1,700 by 8. And that gives us €48,600 in the purchases. Then we take away our 33,100 from part A. That gives us €38,000, leaving us with a gross profit there of €51,300. So that's the gross profit. So that's part A, stock valuation, complete, okay? Students mess up here because of calculation errors. So I would advise at this stage to just double check your calculations in your calculator, because you're using it so much. It's very common for students to make mistakes there. Right, on to part B then. So product costing. So the following is the budgeted yearly overheads of Grace Limited, manufacturers of computer equipment, which has 3 production departments. So you've got production departments, manufacturing, assembly and finishing, okay? So you've got the budgeted overheads, 180,000 in manufacturing, 99 in assembly, 36,000 in finishing. And you've got the budgeted labour hours in each department, okay? So 36,000 hours in manufacturing, 18,000 hours in assembly and 4,500 hours in finishing. Then you've got your wage rates per hour, €4 in manufacturing, $2.50 in assembly, $3.75 in finishing. Then it says budgeted general administration costs for the year, 1,170,000. Then it says details of job number 666, direct materials 30 kgs at €10.20 per kg, direct labour hours, manufacturing 20 hours, assembly 6 hours, finishing 4 hours. All orders are priced using a profit margin of 25%. So what is required? So part 1, calculate the overhead absorption rates for each department. So what that's looking for, that is basically just looking for a per hour rate. So a rate per hour, okay? Now, what we'll do is all we're going to do, we want to break down these budgeted overheads here into a per hour basis. So all we're going to do here then is we're going to take the budgeted overheads and we're going to divide them by the amount of labour hours. Okay, so you'll divide 180,000 by 36,000 labour hours. you'll divide €99,000 by 18,000 labour hours, and you'll divide €36,000 by 4,500 hours. So in manufacturing, that's going to work out to be €5 per direct labour hour. In assembly, it's going to work out to be €5.50 per direct labour hour. And in finishing, it's going to work out to be €8 per direct labour hour. So that is part one done. Calculate the overhead absorption rate for each department. So you're just breaking down the overheads, the huge figure, into a per hour basis. Okay. Now, 2013 part two, calculate the selling price of the job. So look, you do have budgeted overheads, okay? You do have labour, okay? You'll have to work that out. You do have admin costs, and you also have direct materials here, okay? So it's also saying to us later on then all orders are priced using a profit margin of 25%. So the details of the job are as follows. So direct materials, 30 kgs at €10.20 per kg. That's €306. Next, then we'll look at the budgeted overhead. So we worked out the rates in the last part, okay? And what we're going to do, we're going to multiply them by the 20 hours, 6 hours, and 4 hours. So this is what we got in part one, our €5 per hour, our €5.50 per hour, and our €8 per hour. So that works out to be €100, €33, €32, and in total €165. Now, then the wage rate. So you've got the 20 hours, the 6 hours, and the 4 hours. So 20, 6, and 4 multiplied by €4 per hour in manufacturing, €2.50 per hour in assembly, and €3.75 per hour in finishing. Then we've got the general admin. So you can see here that the admin costs are 1.17 million for the year, okay? Now, how are we going to break that down? So what we'll do is, for the year, there is 36,000 hours, 18,000 hours, and 4,500 hours in total. So if we divide the 1.17 million by the total of them hours, which is 58,500 hours, and then multiply it by 30 hours, which is the amount of hours in job number 666, that's going to give us €600. If we tot all that up, 306, 165, 110, 600, we get 1181. Okay. Now, we're told that all orders are priced using a profit margin of 25%. Okay. So a profit margin of 25%. So that there, total costs are 75% of the selling price. So if we divide that by 75, multiply it by 25, we get 393.67. And then our selling price would be 1574.67. So that is part B done, the product costing done. Moving on now to part C, which is under and over absorption. So let's take a read. So it says, the information set out below refers to the budgeted and actual costs of Hake Manufacturing Limited. So here you've got the budgeted hours. This is what the management accountant has come up with. So they're sitting with their Excel spreadsheets, they're looking at past data and prices, etc. And this is what they think they can, run these departments for. So they think in Department A, there would be 7,000 labour hours, 32,000 machine hours, and it would cost 160,000 in total. That's what they think. In Department B, they think that it would they think it would take 48,000 labour hours, 7,000 machine hours, and then €33,600 in total. And Department C, they think it would take 22,000 direct labour hours, and that it would cost €46,200 in total. So that is what the management accountant thinks that those departments could be run for. Now, part one of the question is asking to calculate departmental overhead absorption rates for departments A, B, and C. So basically, they want to break these overheads here down into a per hour basis. Now, how are we going to do that, right? We're going to be taking these figures here and we're going to be looking at the most dominant activity in each department. So in Department A, there's 7,000 labour hours, 32,000 machine hours. So the most dominant activity is machine hours, 32,000 machine hours. In Department B, we've got 48,000 labour hours, we've got 7,000 machine hours, so the most dominant activity there is 48,000 labour hours. And then in Department C, there's only one activity, it's labour hours, and there's 22,000 labour hours. So what we're going to do, we're just going to divide the overheads by the number of hours of the most dominant activity. And this is the overhead absorption rate then that the management accountant has come up with, okay? So the management accountant would say that it would cost €5 per machine hour in Department A, 70 cent per labour hour in Department B, and then €2.10 per labour hour in Department C. So that is part 1 done, okay? Now part 2 asks us to show the over absorption by department and in total for the period and explain what these figures mean. Okay, so we're after looking at what the management accountant thinks each department is per hour. So 5.70 cent and €2.10, right? That's what they think it could be run at. But you can see here that the hours that actually happened, so here's the actual data, so the data that happened after the fact, okay? So the budgeted hours happened before the job happened, but actual is what actually happened. So the production manager managed to do this. So we can compare then how did they do compared to what the management accountant would have thought, okay? So what we're going to do, we're going to take the rates from part A and multiply them by the actual hours to see what the management accountant would have thought they could have came in at. But here are the actual hours, okay? There's the actual hours, so we'll be able to compare. So here's the actual hours. We're going to take the actual amount of hours and we're going to multiply them by the rates that we came up with in part 1, okay? So we've got 37,000 hours multiplied by €5 per hour. 185 is what the management accountant would have thought it could have come in at, but the production manager actually got it in at 175, so that is great. In Department B, the management accountant thought it could come in at 28, but it came in at 29, so that is not great because the production manager therefore would be, €1,000 over. And in Department C, the management accountant would have expected it to cost 56,700, but it actually cost 50,000. So that is really good because they would have come in 6,700 less than what they would have budgeted. So profits are going to be 6,700 more. So that's really good. So you're asked to explain what all these figures mean. Okay, so this first line is what the cost actually came in at, right? But the second line is what the management accountant thinks it probably should have come in at, right? So management accountant thought in the first place Department A should have come in at 185, but the production manager got it in at 175. So what you have to say here is in Department A, the costs incurred were 10,000 less than expected or budgeted, and therefore profits are 10,000 greater than expected. So that is really good news. In Department B then, okay, the costs incurred were 1,000 more than expected or budgeted, and therefore profits are 1,000 less than expected. So that's unfortunate there. In Department C, costs incurred were 6,700 less than expected or budgeted, and therefore profits are 6,700 greater than expected. And then in total, overall, the costs incurred were 15,700 less than what the management accountant would have expected or budgeted, and therefore profits are 15,700 greater than expected. So that is really, really, really good news. Okay, so that's under over absorption, right? We're just comparing what the management accountant thinks that it should have cost. We're comparing that with what it actually cost. And we're saying, did the costs come over? Did they go over or under what was expected? And therefore, are profits greater or less than? what is expected. So that is the 2013 questions, part A, B and C complete.